Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. In the previous part of the series, we explored what volatility is, how to measure it, and how it relates to market direction. In this second part of Understanding Market Volatility series, we will look at volatility from two different perspectives, as an investor and as a trader, and how each can use it to their advantage. Along the way, we'll also examine the role of volatility in options and how it is measured and how it can be used effectively while structuring trades. So without further ado, let's get started. Disclaimers first. The ideas and examples shared in this episode are strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in derivatives involves significant risk and can result in complete loss of capital. The examples and data presented here are meant to explain market behavior and not to suggest that similar outcomes will occur in the future. In the last episode, we looked at the standard close-to-close method of measuring market volatility using Nifty as our reference. If you're looking to build a deeper understanding, it would also help to revisit part 3 of the mean reversion series, where I break down the different ways volatility can be measured, specifically the differences between historical, implied, and realized volatility. Now, as mentioned earlier, we'll approach this from two perspectives, one as an investor and the other as a trader, and understand how each can use volatility to their advantage. Let's start with the investor persona. You might wonder why this even matters. The reason is simple. Irrespective of whether you see yourself as a trader or an investor, you cannot operate without an investor mindset. Trading, in many ways, is built on top of your investments, on the capital, structure, and the stability they provide. While an investor can exist without trading, but a trader cannot exist in isolation. You have to think both as an investor and a trader. For an investor, one of the most important metrics to track when looking for opportunities is market drawdowns. You see, as an investor, you're typically playing a long-only game, which means the opportunities you look for are primarily those that help you accumulate better, specifically opportunities to lower your overall cost of acquisition over time. And drawdowns are those opportunities. If you're new to the concept, a drawdown simply measures how far the market has fallen from a reference point in the past. That reference point could be all-time high, the 52-week high, or even the highest level over a specific recent period. If you'd like to deep dive into this, you can check out the key market metrics video where I explain drawdowns in detail. You see, in a growing, developing economy like India, one approach that has worked reasonably well over time is what's commonly referred to as buying the dip. But what does that really mean? And are there specific drawdown levels that are more attractive than others? At its core, a dip is simply a drawdown, the market falling from a recent reference point. And before we get into any of the metrics, here's a quick caveat. As Anupam Gupta recently pointed out, India's market history is relatively limited to roughly 30 years. Most of our observations and inferences are based on this period. While these patterns may hold, the shorter history compared to markets like the US, where nearly a century of data exists, means we should remain cautious. The future may not always resemble the past, and any conclusions drawn from historical data should be treated with that context in mind. Now back to the investor persona. Now, as an investor, rupee cost averaging through systematic investments or SIPs is a reliable way to capture average market returns over time. Another way to approach this is to actively look for pockets of drawdown in the market, say 5% or 10% or more, and use those phases to deploy lump sum investments. This helps bring down your overall cost of acquisition and in turn improves long-term returns. That's the idea we are going to explore next. Now take a look at this table. This data is of Nifty 50 for the past 18 years. This means that in the past 18 years, we've had just about 20 crashes of greater than 5%. When I say a 5% crash, this means the market comes down 5% from its all-time high and it recovers, and then we calculate the next drawdown. As we speak, we had a 15% drawdown recently, and that's like 7 instances in the past 18 years. That's how rare these drawdowns are. Psychologically though, this becomes even more relevant if you are investing directly in stocks. You have to differentiate individual stock behavior from index behavior. Individual portfolios can go through much deeper drawdowns, and that's the nature of direct equity investing. Each stock has its own price dynamics, and what works in one market environment may not necessarily work in another. That's also why making consistent predictions about individual stocks is extremely difficult. Indexes, however, behave differently. By design, they represent a basket of relatively stronger, better performing companies. As a result, they tend to be more resilient and often recover faster from drawdowns compared to individual stocks. So in short, as an investor, it's a good practice to track market drawdowns. One of the reasons we highlight them in our weekly market metrics videos is to identify potential opportunities to invest, helping you lower your overall cost of acquisition. That said, this approach is best suited for benchmark indexes like the Nifty 50 rather than individual stocks. Now moving on to the trader persona. As a trader, there are broadly 2 ways to leverage market volatility. The first is through trend following. Now, if you're new to this idea, you may want to check out the series we've done on the basics of trend following. The links are in the show notes. As a trend follower, you are not trying to predict market direction. You simply follow the signal. If it's long, you go long. If it's short, you go short. Now, in reality, as we just noticed, markets don't crash very often. More often than not, they tend to move upwards. So even as a trend follower, a significant portion of your gains is likely to come from the long side. At the same time, if you want to be well positioned for market drawdowns and capture downside volatility, you need to participate in the short trades as well. They may be fewer in number, but they are essential. They are your only way to benefit from sharp moves on the downside. Let me illustrate this with an example. We'll take a 50-period exponential moving average crossover on the hourly time frame on Nifty spot. What you're looking here is the yearly P&L broken down by direction. The top section represents returns from the long trades, while the bottom section represents returns from the short trades. Now focus on the short side. You'll notice that in years where the market went through significant drawdowns like 2020, 2022 and 2026, that's where the short trades really start to contribute. Now, let's try to understand this from a different perspective. Let's look at the index, especially the times where Nifty was really stressed and it was in a drawdown of greater than 10%. During those instances, let's see if the trend following strategies, especially the short trades, contributed or not. Now, if you look at the table closely, every major drawdown phase has contributed positively to the short side of the strategy. What this really reinforces is a simple idea. If you want to benefit from downside volatility, you need a mechanism to participate in it. And trend following is one such approach that allows you to do exactly that. Now moving on to the other approach, the other way in which traders can benefit from downside volatility. At this point, I will refer back to the part 3 of the mean reversion series, where we spoke about how during times of stress in the market, the IV implied volatility increases. And VIX or India VIX, which is also known as the fear index, is a fairly decent proxy of the implied volatility. Now let me show you something. We go back again to those 13 episodes where markets experience 10% or greater drawdowns and see what happened to VIX during that time. Do you notice something interesting here? Out of the 13 instances, in 12 of them, the VIX was rising. Now you might ask, what do we do with the rising VIX? How do we actually make the most of it? On a positional basis, you could take discretionary approaches like short straddles, short strangles, or iron condors. But I want to connect this back to something we discussed earlier, that is the 920 straddle, which was a dedicated episode of its own. The rules remain exactly the same that we covered over there, so do check it out. Now let's see how that strategy performed during these same periods of market stress. While the earlier dataset was from 2015, this one starts from 2019 since weekly options weren't available before that. Even then, it gives us a fairly good sense of how things work in a high IV environment. What's super interesting is that short vol strategy actually performs better during periods of stress than when the index is near its all-time highs. The median PNL during stress is 8,954 compared to minus 3,608 when Nifty is near its highs. Of course, there are exceptions like November 2024 or the current March to April 2026 phase. It's not just elevated implied volatility that drives performance, market structure plays a role as well. Let me reiterate here, I am not trying to say that these are the only periods where short vol works. What I shared here is just a snapshot of sorts. But the fact is, short vol works better especially during the period of high IVs and the subsequent period of declining IVs. The broader takeaway here is this. As a trader, you have multiple ways to benefit from periods of market stress. What we've highlighted here are two. Trend following, which plays out over multiple days, or short-term strategies like the 920 straddle, which operates on an intraday time frame. And yes, if you are an investor, then you know what to do. So that brings me to the end of this episode. We've looked at volatility today through two distinct lenses, the investor and the trader. For the investor, the message is clear. Don't fear the drawdown, use it. In a structural bull market, deep corrections in benchmarks like the Nifty 50 are high probability opportunities to accumulate quality at a discount. For a trader though, volatility is the very engine of profit. We explored how to capture it in two different ways, through trend following, which rides the downside volatility, and through short vol option strategies which harvest the fear premium when implied volatility spikes. If there's one takeaway today, it is this. Volatility is not a signal to move to the sidelines. It is a call to action. But, and this is the most important part, it must be a calculated action. To borrow from the late Daniel Kahneman's book, Thinking Fast and Slow, market stress is the ultimate System 1 trigger. In moments of panic, our brains are biologically wired to choose flight, to sell at the bottom, or freeze when we should actually be leaning in. This is our primitive, emotional brain trying to protect us. But in markets, those instincts are almost always wrong. Success in these moments depend on our ability to engage System 2. This is our slower, more analytical and logical mind. System 2 doesn't trade on feelings or fear. It trades on data and predefined rules. By shifting from the panic of System 1 to the process of System 2, we stop being the victim of the market's mood swings. Whether we are investing or trading, volatility indeed has something for everyone. With that, I come to the close of this episode. I hope you found this episode useful. If you have any questions, feel free to drop them in the comments. I'll be happy to respond. Till then, take care and trade safe. I'll be back soon with the next one.